We are witnessing the great banking collapse of 2023, but should we be worried about the safety of our financial system? Well, let's dive into this story and talk about what's happening. Before we begin, make sure to subscribe and let us know your thoughts below. The collapse of Silicon Valley Bank has sent shockwaves through the U.S. financial system. The bank, which had been serving the tech industry for over 30 years, succumbed to a traditional bank run on March 10, 2023. As a result, state regulators were forced to step in and take control of the bank, appointing the Federal Deposit Insurance Corporation as its receiver. The collapse of SVB represents the largest failure of a U.S. lender since the global financial crisis of 2008 and the second largest in history. Why did Silicon Valley Bank collapse so suddenly? To put it briefly, Silicon Valley Bank's collapse was a result of insufficient cash reserves to cover the demands of depositors, leading to regulatory closure of the bank. However, the situation is more complex and rooted in the pandemic, when SVB and several other banks experienced a surge in deposits that exceeded their lending capacity. In 2021, deposits at SVB doubled, and the bank had to find a way to utilize the excess funds. Therefore, they invested in highly secure U.S. Treasury securities for the unlendable portion of the deposits. Nevertheless, the problem arose as interest rates increased rapidly in 2022 and 2023, causing a decline in the value of these securities. It is common knowledge that bonds and comparable securities follow an inverse relationship between yields and prices. Hence, when interest rates rise, prices of securities fall and vice versa. According to recent reports, Silicon Valley Bank suffered a significant loss of $1.8 billion due to the sale of some of its U.S. Treasury securities, which it was unable to offset by raising capital as its stock value began to drop. As a result, venture capital firms advised their invested companies to pull their business from the bank, prompting a growing number of depositors to withdraw their funds as well. These investment losses and withdrawals were substantial, leading regulators to intervene and close the bank down to protect depositors. However, the Federal Deposit Insurance Corporation, FDIC, has taken over and is now managing the bank. From a practical standpoint, the FDIC typically shuts down a bank on a Friday and reopens it the following Monday. In this case, the FDIC has announced that the bank will reopen on March 13 under the name Deposit Insurance National Bank. Therefore, it is safe to assume that deposits will continue to be protected by the FDIC insurance. As of the end of 2022, Silicon Valley Bank held $175.4 billion in deposits. It is unclear how much of these deposits remain with the bank, and which of them are insured and considered completely safe. For depositors who had $250,000 or less in cash at SVB, the FDIC has assured that customers will have full access to their money when the bank reopens. However, for those with uninsured deposits, which are anything exceeding the FDIC limit of $250,000, it is uncertain whether they will receive the remainder of their money or not. Such depositors will receive a receiver's certificate from the FDIC for the uninsured portion of their deposits. The FDIC has announced that it will make some payments to cover uninsured deposits by next week. It is also possible for additional payments to be made as the regulator liquidates SVB's assets. If Silicon Valley Bank's investments are sold at a significant loss, it is possible that uninsured depositors may not receive any further payments. Prior to the collapse of SVB, the most recent U.S. bank failures occurred in October 2020, when Almena State Bank in Kansas and First City Bank of Florida were taken over by the FDIC. These banks were relatively small, with a combined total of around $200 million in deposits. Compared to these smaller banks, SVB was a much larger institution, and its collapse marks the largest bank failure since September 2008, when Washington Mutual failed with $307 billion in assets. This happened in the aftermath of Lehman Brothers' collapse, which almost caused a global financial crisis. In general, Bank failures in the United States are relatively uncommon. For instance, there were no bank failures in either 2021 or 2022. The risk of more banks failing is currently low, as Silicon Valley Bank's collapse is not expected to cause a ripple effect on other banks. While SVB was the 16th largest bank in the U.S. at the end of 2022, its assets only accounted for 0.91% of all banking assets in the country. However, SVB's failure does highlight the risk that other banks face in their investment portfolios. If interest rates continue to rise, as the Federal Reserve has indicated they will, the value of investment portfolios of banks across the country could continue to decrease. This situation could potentially lead to investment losses and liquidity issues for some banks. While these losses are just on paper, meaning they're not realized until the assets are sold, they still can increase a bank's overall risk. How much the risk will go up will vary from bank to bank. While the failure of SVB has certainly caused some market turbulence and raised concerns about potential risks in other banks, it is unlikely to trigger a full-blown banking crisis. The banking sector has undergone significant regulatory and structural changes since the 2008 financial crisis, and banks are generally better capitalized and more resilient than they were then. Additionally, the failure of one bank, even a large one like SVB, is unlikely to cause systemic problems for the broader financial system, unless there are larger underlying issues or weaknesses in the financial sector that are exposed. However, it is still important to closely monitor any signs of stress or vulnerabilities in the banking sector and address them before they become more serious. Overall, while there may be some stress and volatility in the financial markets following the collapse of SVB, there is little indication that it will trigger a wider banking crisis. Most banks currently have strong financial buffers to absorb losses, and regulators are taking steps to prevent the failure of other financial institutions. However, there are still risks to the financial system, particularly if interest rates continue to rise and cause further losses in bank investment portfolios. It will be important to monitor the situation closely in the coming weeks and months to see how it evolves. Thank you for watching The Financial Scoop. Make sure to subscribe and leave us a like below if you found this video informative.